Well, hey, everybody. Welcome to a Thursday podcast. It's a Ken Braverman podcast. We're talking about the Straddler, talking about a stock options algorithm, information recorder kind of weird thing that I've been working on to try to figure out how to, optimize. Investing is the word people use when they think about putting money into the stock market. This is much more short-term plays on volatility, at least the way that I've set this algorithm up. But here's the thing, it works. It works, and it works so much that I'll share a personal story with you. One thing I've been blessed in life is to run into a good deal of smart people and have some smart friends. And I've got a friend I've known for a long time who went to really what's regarded as the best engineering high school in the country, basically. A really smart guy, and he always helps me with probability problems whenever I'm having trouble with probabilities. I always don't understand probabilities the best, and combinations of probabilities. But I got him into learning the stock options straddle strategy. And so what's going on here is it takes some dedication to kind of understand what's going on here and why this works. But when you get the hang of it and understand what you're doing, boy, it doesn't have a lot of negatives. It's a calming way to invest because it's fun watching it. And all of a sudden, when weird things happen, you end up making more money than normal because you have an option in both directions on the same stock. You're doing some stuff that's kind of tough to understand. Well, that friend, he started looking at the sheet and he started understanding what was going on at purchase, and he's like 5-0 on companies so far that he's been able to sell at a profit. And he also cued me into something that this algorithm needed, which is it needed to know when the company is reporting earnings. That's a huge relevant factor in here. I had no idea how much better adding that information was going to make this sheet. So since I have added it yesterday, I wanted to talk about it today and also say that when the smartest people I knew are going hand over fist to either start doing this themselves or give me money to trade for them, you know that something really good is going on. I mean, this is not sports betting stuff. This is the legit math in the largest marketplace in the world, $47+ trillion or something. There's a ton of money in the market. It is where we as a global community decide to put value into certain organizations that are doing something, right? Whether they're providing products or bettering the planet or making the planet worse, they're doing something and they're making money, right? So this is where the world has decided to pump all of the collective currency and belief in value in our society and countries and nations and the world as a whole. It's all dumping into here. So this is where all the money is. So when we're thinking about ways that we can passively/actively make more money investing in the market on a daily basis, well, what are you trying to do? You're trying to say, hey, we've got this big, huge, volatile world out there that is slinging money around on a $1 trillion basis every day. How do we find a way to get involved in the market so that we, one, limit our risk, and two, try to maximize how much money we can make, or just at least reliably make money? Well, I found that options are better than stocks because options are a contract that enables you to purchase 100 shares of a company at a given price or sell 100 shares of a company at a given price. That's what an option is. So it gives you sort of 100 times magnitude of the impact of your decision on the value of your security or your stock or in this case, your option. So I found that options are better for higher volatility in a shorter period of time than stocks are. So your risk tolerance has to go way up if you're going to be trading options. Fair enough. Risk tolerance raised. I'm willing to buy options and have my decisions have drastic market value changes on a daily basis. I'm willing to have that, right? That's going to be something we're going to accept it as a variable that is high. And there's going to be a lot of trading on these options. Now, if you're going to do that, what are you trying to do? Well, you set up this algorithm here to say, all right, if you straddle the company, meaning you buy a call and a put option at the same price. I have the prices, the strike price of the company that we're looking, like what number are we naming? We're naming the number that they're at right now, because we are anticipating that the company is going to move a certain amount in one direction, absolute value, one direction, more than the cost of buying the call and the put together. And that enables you to then sell one of those options, either the call or the put, when the company moves that much. What does that mean? And why am I looking at the companies in this order? And now let's start talking about decisions that you make, given that the algorithm has already done a ton of math for us and sorted this list by what it thinks are the best companies to straddle right now. Right now, here at 12:36 p.m. on the East Coast, what should I do with my available balance to purchase options? And we're going to go through that and we're going to make a purchase. So first thing that pops up enormously is Discover Financial Services. So the algorithm has a really good record at having companies that have super distorted today's boom numbers, which I'll explain in a minute. The higher the number this is, the better, and more than 100% is fantastic. The over 100% club of companies, and I'll explain why this is important in a second, but if they are over 100% on today's boom number, those are what are called like empirical winners for today. So you can go all the way down to, there's a good deal of companies here. This file is a little slow sometimes because it's doing a ton of things, querying current prices of companies, running formulas, doing conditional formatting stuff. Like this file, this Google Sheet's doing a lot, right? Google's trying to wait. So there's a lot of these that are over 100%. It's basically almost all of these. It looks like it's the top 40 companies on here. OLED, Zscaler, Atlassian, Gilead, Whirlpool, American Tower, the Hartford Financial, Applet, T-Mobile is up here, CrowdStrike, Appian, Marketflare, Cloudflare, Netflix, Roblox. Now I need to change some things to make sure these companies still have really high boom numbers. But what it is saying is that the company moves so much today that you made 4 times the cost of the options on one of them today. What does that mean? That means that basically what we had in here, they dropped from like 120 to 122. They're down $19. Okay. So make it as simple as possible. They moved $19.62 a share. That means that the put that you owned on them just increased in value by $1,962, $1,962, because that's the 100 times value movement change thing, and intrinsic value of that option just moved by that. If you had a strike price of 120, they're now at 102. So the difference between 120 and 102 is 18. That's $1,800 in intrinsic option value that exists on that put. I know that's some complicated, fast talking, but you'll have to get stock options down at some point without my help to understand what they are. But this is how their value changed. So the algorithm sorted this in this order because it knows that. And it's like, whoa, you could have paid $482 for options on them. Now, I now have to update other things in this file to get a current look at how much this actually costs. There's an option expiration date. There's an earnings date. There's a bunch of stuff that happened that we kind of want to analyze as well to determine if Discover is a good purchase for us or not. Already the algorithm's saying absolutely yes, 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 because they moved so much. So in that sense, it's saying do it. But there's something that happened here, which is Discover reported earnings, I guess today or this morning or yesterday. This is the next earning date is 3 months away. So they must have just reported today. And it said that it was lower than expected. It was bad. Well, because of that, that's why this huge drop off occurred today, as everyone decided to get out on bad earnings. Well, the reason why I added earnings report in here is companies that have earnings coming up are going to show some value ahead of time as people buy into the earnings or sell into the earnings. And then the earnings report comes in. So what we have to do is we have to change the actual prices of these options to find out if they are the same price that I had last week when I enter this stuff in for the option period that ends this Friday. Well, there's a new option period you need to buy this option for to have them when earnings happen for Pulte, for MDC. Looks like Abbott Labs just reported and they went up. We'll have to see how much they cost now. Point is we have to update to see if these are the best or not. One thing that pops out at me is I saw T-Mobile on here. T-Mobile is historically a really good one. Let's see what happened with them today. They have earnings in 7 days. Great. So this is one I'm going to look into right now simply because I actually did lose on them for the first time ever last week. I lost a small amount, but usually I win. I've won like 5 times in a row. And I also had the biggest win percentage-wise ever on a company on T-Mobile when they dropped like $10 in one day. So let's talk about the option period 728. Currently, they are at 140 and 67 a share. Let's give them a strike price of 140. That costs $385, between $385 and $400. And the put is between $300 and $310. That is unfortunately expensive. Yeah, see, that lowers them to a 46% boom. So the boom number, I'll explain what that is. That's the percentage amount they moved in the day based on how much they need to move to make money on selling one of the 2 options that has just moved. So you want this number to be over 100% because they move more than they need to in one day, right? But your option is going to expire sometime in the future. In this case here. Well, this is too much. I'm sorry. This is too much. So everybody knows that T-Mobile is a big mover and they know their earnings are coming. And as much as I would like to buy them, the algorithm actually says no. It says they're sorry. They're too expensive. They have to move 5% between now and the 28th. And while they probably pull something like that off because they're T-Mobile, it's too much to risk for a company that's only $140 a share. That's a pretty decent price. It's saying, that they moved to 132 or 147 before next. It's possible, but it's too much even for them. It's this boom number, break-even boom percentage is just too high. So we're going to say no. And we're going to resort. We really need to discover more because another thing I've learned about doing this algorithm is that when stuff is showing up way at the top distorted like this, you have to really convince yourself not to buy it in order not to buy it. Like you really should be buying this. So let's see if we really should buy this. I just updated this. I'm gonna go back. I'm looking at the options menu. You cannot scrape this information automatically. You can't do it. It doesn't work. It's not possible that I know of on any service that I've looked into. Google Sheets says they have a formula, but I've never been able to get it to work to call the options bid ask price at a given strike price. There's a code, there's a string that exists that is that, option, the price, the date, the bid. There's supposed to be a call to do that, but it doesn't work. I've never seen anything work. So if you can help me with that, I'd love to populate this automatically with the bid ask prices. But as right now, you have to do it manually. There's literally no other way to get that information. It changes so fast and it's based on what people are offering and buying. And it's just really tough. So I grabbed it just a few minutes ago. Well, I mean, they took this big loss today of 19 because they reported earnings. Are they going to move another $5 before next Friday? Man, are the ripple effects of their earnings and maybe any other credit issues or whatever, is that going to affect them over the next week? They're $102 a share though. They're not that big of a share price. Man, it's a really tough call. I would say that if this number was lower than 3%, I would do it. Meaning the break-even boom number needs to drop to below 3%. Below 3% is much more reasonable in terms of movement. This is too high. So I'm going to say no, but man, is it close. If their share price was 150 a share, I'd do it, but not at 102. That's why this number is high. So it's going to be a no, even though they're a huge mover today. What about Genuine Parts Company? Here's a company that clearly just reported earnings. They're a higher share price. Now let's see GPC. So they only have one that goes out to August 18th now. And their new strike price is 155. It's between 380, 420 and 280, 310. I'm thinking it's going to be way too much because it goes out. They still have a boot number that's over the price of this, but it's $700. And I'm going to say no because it's a longer option that goes out till August. They're not as big of a mover in general, and they just reported earnings. Stuff that just reported earnings, we don't want as much because we want the ones that are having earnings coming up so that we can have them during that period, right? AbbVie is another one that's been good. I'm actually going to check them out. They are deceptively cheap for $140 share price. Let's look up AbbVie because that's probably one I'm going to buy. I have purchased them multiple times and I've never lost purchasing them either. And it's because they're exceptionally cheap for their share price. So let's go over to strike price of 141. Yeah, kind of expensive, 360 to 370 and 250 to 256. So the market's caught up with them a little bit and priced them appropriately here during earnings. And you'll see that this is only a 67% movement today of $4, but they cost $600. So they are expensive. I'm not going to buy it because it's still not that super great deal. It's important how much you pay for these options, meaning that's your risk amount. You want this number here, this cost risk number, to be super low. As a matter of fact, I'm going to sort it by the cheapest on here for a second. Because unless the company is an extremely low share price, which of course all of these pretty much are, this is a really important factor because it means you're just only risking a small amount. That's why like Cisco has been a fantastic one. Cisco is another one I've never lost on. We could just buy a Cisco right now or buy a few to explain how to play this with a company that's ad service TD Ameritrade. A lot going on. I'm using TD Ameritrade to grab these bid and ask prices, by the way. They're the best. They're the best, honestly. They're a really good company and they offer great service. So let's go look at Cisco because Cisco, I can just tell you this is a buy. And I'll explain why. CSCO. So the 728 option period, which we have in here, it's saying between 81 and all right. So they've moved up in price recently. And so the new strike price is 52.50. They're between 81, 83, 48, and 50. Now, this puts them at wow, a total cost of $131. I used to get them at like $95. They used to be cheaper. It's actually a little more expensive than I wanted. For that reason, I'll stay away from it. But when you can get this option for under $100 for a week like that, they move a dollar. It's so easy to make money, and that's why you can make money on them frequently. But let's go back to the other sort because this is the sort we're supposed to use. So J&J. Johnson & Johnson. That's another one that has been successful in the past and that I've made money on when I've purchased that. Right now, they just reported earnings, right? Is what just happened. You need to go right here, and their options are going to cost about about over $400. It looks like, which is going to be too expensive. Well, no, that's what they were last time too. So their new strike price is $167.50, between $271, $310, between $105 and $119. So it's going to cost you only $387 apparently. No, $402. Okay, so it's $400. So what are you trying to have happen with Johnson & Johnson? Because this is probably going to be a buy, I can tell you from historically looking at them. So they ended up, apparently, I'm going to read the note on them to see what happened with their earnings. Earnings were probably what, better or worse? They went up, so it must have been good. Johnson & Johnson shares are trading higher after the company reported better than expected Q2 results and raised its guidance. Okay, so here is what is generally thought of as a more sustainable set of news related to earnings that will probably, unless people are running to take a bunch of profits on them immediately, it's probably going to lead to more sustained increase in this company. So for $400, you're saying, are they going to go up to 173 within the next 6, 7 market days? And they're a pretty high share price. You can see this is only $400. It's not one of these $700 ones. They don't have to move, and they're already at 169. So this is a very, very good thing. Look at that break-even boom number of 2.38%. They don't have to move that much. Today they moved 2.5 times as much as they need to. I know they just reported earnings, so today's the day you would expect the largest movement out of them. But you still, all you need is $4 more, and they moved 10 already today at not even 1 p.m. So we're buying that, everybody. And I'm going in there, and I am buying the I'm going to buy the 167.50 call because I also think they're going up. That's the direction I think they're going. So I'm buying that at the market rate. It says I'm paying $305. And I did. Okay. Now I need to buy the put option. As you can see, I'm going to pay a little bit more than 400 because I'm paying market rate, but I'm okay with that. There's such a good deal that boom number is so low that I don't mind slightly overpaying by paying market. Because I just want to get it done just to show you that this is how this works. Because sometimes you can't rely on waiting for your order to go through. I just paid $121 for the put. So I paid $428 after fees, basically. I paid $428 here, overpaid slightly. I'm expecting them to move $5 or more in one direction before next Friday. Algorithms are really good at doing this, so they're probably going to be fine. They might even keep going up today as more people read into what their earnings were, right? And at some point, people will take profit. So my goal is to have them go up. They actually don't even need to go up $5 because of the structure with which I purchased that option. Let me explain why. So we chose a strike price of 167.50. So my goal, here's what I'm trying to do, is I'm trying to get them to move enough that as soon as one of the options moves enough, I sell it for more than $428, right? I need to sell it for, more than, I need to sell it for at least $450, let's say, or even $5. Like, what type of profit threshold do you want on this first sale of one of the options that you're selling? I say that if you can get 10%, it's fine, because you don't realize you have another option that's still live for a period of time. So for example, let me give you an example of what might happen. Let's say that in the next day or so, they go up from where they are at 169 and they get to 172.50. Okay. That means they go up like almost $3. More than $3. Yeah. $3.50 they go up. If they go up by that, or no, it's just $2.50. $2.50, right? 70, 71, 70. Yeah. If they go up about $2.62, that's all they need to move. Then the call option that I just purchased here for $305, that thing intrinsically will be worth $500, because 172.50 minus 167.50, which is our strike price, is 5. That times 100 is $500. So you'll be able to sell that call option for even probably a little more than 500. And I only paid 428 for both options. So the goal is to have that happen as fast as possible and just sell it when they get to $500. Then you hope they go down, and you hope you can sell your put, which you still have, for some more money than it's worth at that point. And that's how you make money consistently doing this. So I mean, it's a long video, but it's explaining like the process of what I have to do with this file to read it properly every day and determine what to buy. But when you do it this way and you stay at the top of the list here, you have good things happen and you win frequently. And now we're going to tie that into earnings, and we're going to start looking at companies that have earnings. Like, let's look at this Meritage and see what they cost real fast. This is Meritage Homes, Household Durables. They took a huge drop today. Okay. and they're 7 days ahead of earnings. Okay, so what's going on? I'm gonna look at their option chain. Okay, their option goes out to August 18th. So this is going to be more expensive because this is a longer option. But longer options, there's nothing wrong with longer options, guys. Companies are still going to move and you retain a lot of value of the premium when the option is longer. So they've dropped. So the new strike price is 135. Oh boy, this is way too expensive though. It's between 790, 820 because everybody knows they're moving and they got earnings coming. Yeah, this is way too expensive. This costs $1,255. You can see the boom number changes because all of a sudden this costs a lot more for that option now that we update. It's not even at the top of the list anymore. So that's a good thing about updating this and redoing this is you get a new list. You can see that Johnson & Johnson is still on the list as number 2 when I updated them. Discover's still on the list, but their share price is lower at only 102 and that break-even boom number is higher. You want this number to be green over here with the break-even boom. You want the cost to be low, here, like these are looking good. Like Pulte, Abbott, like Abbott Labs is probably worth the purchase, actually. Let's see how much they cost right now. Let's update them because I didn't even have anything since a previous option period. This was a while ago. So this might be more expensive. Abbott Labs. This is work, folks. This is a job, but it's a job that pays. I want to do videos about methods of making money online from home, from in front of a computer, because that's what sports betting kind of was supposed to be. It's just too hard and doesn't work all the time. It doesn't have consistency. This, much more consistent. So your Abbott Labs costs $273. And they're at 111 and they've gone up after their earnings. Well, it's still pretty cheap. You can see the difference between Discover, which is $102 a share. You got to pay $482. Here you only have to pay $273. I've purchased them before and I've made money with them before. I'm very tempted to do this. They moved $4. They need to move $3 off of 111. That is close, but so what? They must have reported good earnings. Let's see what it says. See if it's going to be a sustained uptick for them or something. The note on their earnings, which were reported today or are reporting today. Actually. They haven't reported yet, maybe. Is that right? Let's look. Their earnings date is the 20th, but is it aftermarket? No, they announced $1.08. They were okay, they were within range, but at the high end of the range. Haven't seen any real news yet. That's going to make me buy it even more because it's so fast that it looks like it's pre-market. They went up. There's no note in TD Ameritrade. They're pretty cheap, so let's buy them. Let's buy them. They're up here. There's not a lot of reasons not to buy them. So we'll go with the upside. So we'll take the 111 call, which once again, I'm buying at market because the spread range on this company is so low that you can just buy at the market. You pay a little more than you might if you make 2 separate limit orders, but it's also very close to what you're going to pay. You'll see my total price. I just paid, it looks like 179 for the call, I think. Now I'm buying the put. And looks like I'm going to pay 90 something bucks for the put. Yep, I paid 188 and 94. So, all right. I mean, 284 plus 2. So I paid 286 bucks for this instead of 273. So I paid 13 bucks more than I should have, but that's not that bad. It's a very small amount because you can see the spread range is really low. The spread range shows over here. Spread range on Abbott Labs is 3%. that means that these spreads are really, really tight and you have a good idea of what the value of this is. Right? You see, I got the put for 94. Apparently went up slightly over the last minute while I was talking, right? So we own those two now. We own Johnson Johnson, we own Abbott, and you'll see that the algorithm just does amazing things as I track this and show you from day to day, and I keep this updated even more. And we try to pick off companies with earnings that are coming down the pike that are reasonable. Waste Management might be reasonable. We'll take a look at it. They've one that I've made money with in the past. So we'll keep looking. All right. Good luck, everyone. May all your trades be winning.